Hey guys, since we are now officially in tax season, I'm sure many of you are wondering how to protect your wealth from it being taken by the IRS. I've covered many of the tax benefits when it comes to multifamily, but I want to go a little deeper in terms of the benefits and what it means to you as an active owner or a passive investor. Before I go into the four most powerful tax advantages of multifamily investing, please note that I'm not a CPA or a tax attorney. All the information that I'm going to give you here is based on my personal experience and advice from my advisors on various deals. Really, this is a bird's eye view of some of the more powerful tax benefits for any passive investor, and you really should understand them. But talk to your own tax planning advisors and strategists before doing any of these tactics, okay? So let's get into it. First one, depreciation. When you own or are invested in a multifamily deal, you're technically invested in a business. So everything related to that business, from the paperclips to anything that you buy for that property, can be written off. One of the most powerful deductions you can write off is depreciation. So this is how a straight line depreciation schedule works. The IRS ruled that resident occupied real estate has a lifespan of 27.5 years. The land that the property sits on cannot be depreciated as it has an infinite lifespan. So put that aside. So let's say that the property you want to buy is $6 million dollars and the land is worth $400,000. Applying the IRS rule, you're able to deduct 1/27th of the 5.6 million for $203,000 from income each year. This allows you to show a loss on paper as the deduction, helping you eliminate some of that income from that property. So even though you show a loss in your tax return, that money is cash in your pocket and into the pockets of your investors, of course. If you have a portfolio of other investments, then you're able to apply these paper losses to other areas of your portfolio if you have even more losses. This means that your multifamily investment can lower your overall tax exposure to your other investments that you hold. Even as a passive investor in one of our deals, the depreciation in our multifamily deal flows through our investors in proportion to the ownership percentage that they hold in the deal. Keep in mind that I'm not saying that this is going to eliminate your entire tax bill, but there are other tools you can use to help defer taxes for a very long time, if not indefinitely, and even accelerate depreciation. So let's get into that. Number two, cost segregation. Now, cost segregation is a great way of accelerating the depreciation of just about any commercial property, including multifamily. So as I mentioned earlier, the IRS tax code says that the lifespan of a multifamily deal is 27.5 years. However, there are certain items that make up the building, such as the plumbing fixtures to the cabinets, to even the appliances, that have a shorter lifespan. So when a professional cost seg study is performed, an engineer will come out to the property, they walk all the units, they look at the property itself, and they separate out the actual items from the overall value of the property and present you with a schedule for those individual items. So many of those items the IRS deems will have up to a 7-year useful lifespan. So the cost segregation study identifies these specific items. So I'll try to do the math here for you, but again, you can look through the text that helps explain this. But previously I said that you would save $203,000 in taxes through depreciation. Not bad. Let's say the cost seg study for that $6 million property, let's say there's $5 million in building depreciation and $1 million from personal property because we separated it out. So now what you're doing is that 5 million, you're dividing 1 year of the 27.5 years for 181,000, and 1 million of the 7 years for 142,000. So now you have 324,000 in annual depreciation expense. So that's a big savings from the 203,000 we had previously. This will give you an extra great tax offset in income against other investment income that you have. The only caveat is taking this approach could get you hit with a higher tax bill when you go to sell the property. So as I mentioned earlier, there are ways of rolling your gains without getting nailed on taxes. So one way, of course, is number three, qualify as a real estate professional. For many people, real estate is just a means to supplement their full-time job with some additional income. What many don't know is that if you spend 750 hours or more in your real estate business, such as managing rentals, turning units, or things like that, you can qualify as a real estate professional. That's 750 hours per year. So it's very easy to do. This means you're able to deduct 100% of your rental depreciation and your losses against your other income. This designation only helps you if you have ownership in a significant amount of rental properties, so more than just one unit, and you're earning less than $150,000 a year in adjusted gross income. Now, if you're an investor in one of our deals, then you have ownership into that property. It may get you qualified. So again, talk to your CPA about your options with regard to that. And number 4, 1031 like-kind exchange. Earlier I mentioned depreciation as a way of to increase your deductions and reduce your overall gains. A great way to defer taxes on your gains is using a 1031 like-kind exchange to roll your gains and avoid getting nailed in taxes for an indefinite amount of time. As long as that cash stays in that 1031, you can keep multiplying it without any tax implications until of course, you pull the cash out. This is one of the most powerful tools when it comes to deferring taxes and saving you a lot of money. The first thing to know about doing a 1031 is that when you roll the profits from your real estate project, it must be into another real estate project like the one it was in previously, that hence like-kind exchange. This means you cannot take the profits from that multifamily deal and roll it into a new pizza place you want to start up, right? You need to roll that cash into a higher basis property within a set time frame. All right. So again, talk to your CPA about lining you up with the right professional that can do 1031. Again, I'm not a CPA myself, so this information is just based on my own personal experience and my own research. Anyway, have you heard of some of these tax advantages? Let me know in the comments. I would absolutely love to hear from you. And if you like the content, please go ahead and give it a thumbs up and please share it as well. Also, check out the Bulletproof Cash Flow podcast on iTunes and Stitcher, and subscribe to the YouTube channel as well. Still working on getting new content for you guys out all the time to help you build success in the world of multifamily. I really want to see you succeed. So be great, guys, and I'll talk to you again soon.